Hello everybody and welcome to Greenstar Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, back on YouTube with a look at the SPY, the PCC and the VIX today. So we're going to start with classical analysis first and then we'll come over to the Elliott Wave ideas later. Right, so first things first. The rally that everybody loves to hate continues and doesn't show any sign at all of being over. Now, I've witnessed, as I've mentioned this many times now on this YouTube channel, if you go back and look at any of the stock market videos over the last, well, since the lows back in October 22, and especially since the lows back in April 25, have frequently mentioned that this is one of the most hated rallies I've ever witnessed. Now, I've been bullish since the lows on April, but even I have been expecting and anticipating some kind of pullback, and it will not, and has not, materialized yet. That's fine. I'm still bullish, I'm still long. I would like to have gotten a lot longer but there hasn't been any significant pullback. This makes diagnosing where we are within a broader Elliott wave count very difficult, because if there's no significant pullback, we've completed no significant wave degree. If we completed no significant wave degree, we don't have much certainty as to where we might be within the bigger picture. So the rally continues. And for as long as this rally remains hated, chances are it will continue, if you take my meaning. Once everyone's in and once everyone's bullish, then we can talk about reaching a macro top. But there are still far too many bearish voices out there at the moment, I feel, for us to be in that circumstance. And with rates being cut and future rate cuts being promised, global M2 still pointing up, we've got a lot of reasons to not call bullshit on this thing yet. Okay, and when the time comes that we have to call bullshit on it, we'll deal with that as and when. But in the meantime, not an issue. So let's get on with the classical analysis then, shall we? So first thing I want to look at is our exponential moving averages on the daily time frame. So we're above the 10, the 20, the 60, the 250. We have not crossed through the 10 and the 20 and reached the 60 exponential daily moving average once since crossing back above it, and that was all the way back in May, suggesting that nothing that we've witnessed, none of these little 2.5% or 3% pullbacks, comprise of any significant wave degree in our Elliott wave count. They're all smaller wave degrees within a much broader move, and we've yet to witness a larger wave degree correction, hence why we've all kind of been anticipating some kind of pullback. Right? Eventually it's going to come. Maybe not. Maybe it will, maybe it won't, but it hasn't yet. Larger wave degree corrections work their way down to the 60, larger ones still work their way down to the 250, and really big ones smash their way all the way through it, and we have to look out to larger time frames to find moving average support, if there is any at all. Now on the RSI, we can see something very interesting that's been happening. So we were looking at this bearish divergence that was building up since the peaks back in July, and we saw double divergence building up. We could even say it was triple divergence, for a while, because we had yet another move from this high to this low here. This high to this high here. So that looked like triple divergence, right? Building up, anticipating some kind of significant correction. So we had lower highs in the RSI and higher highs in the price, except all of this divergence led to nothing. Right? No significant pullback. Here's that divergence, here's this divergence, here's that final divergence from this high to this high to this high to this high. No pullback. We just swing above the previous high in the RSI and above the one before it, straight into overbought conditions, which we've done with this high. Pre-market's trading above yesterday's high. So a return to form, a return to strength. Whatever this was, it was more likely smaller wave degrees stacking than it was finer wave degrees within a wave count. Now they could be 3 into 4, 3 into 4, 3 into 4, 3 into 4, but why are they getting smaller rather than bigger? If there were larger wave degrees, they'd be getting bigger, and we would continue to see this typical 3 to 5 divergence. It's not here anymore, right? And the slowdown in the MACD, the continuing decline across these highs in the MACD, has also broken out with an increase in the histogram, average line crossing through the signal and moving above previous highs. This shows a surge in bullish momentum. Not what we'd expect if we were topping. OBV downward trend in the OBV, higher high to lower high to lower high. That has also broken out, and now we swung to a high. Not a high above the previous one, but above some of the ones in that sequence. So it would appear for the moment that there is no top in place. We can see that. We haven't got a pivot in place yet, so we've got quite a bullish candle here. When the pivot occurs, we got a pivot on the daily time frame, and then one out on the weekly time frame. Big bearish candle off the back of divergence, gobbling up several days or even several weeks worth of bullish price data, and breaking the current trend of higher highs and higher lows. We can say, all right, we've got a pivot in place. There isn't one at the moment, so market's pressing on. Shorting this would be like trying to sit on top of a rocket, hoping it comes back down while it's still got half its tank of fuel or maybe more on board. It wouldn't be a good idea. Okay, but being long here, yes, we haven't had any significant pullbacks, so really leveraging in has been very difficult, but we've got multiple higher lows that you can still trade off of with pretty manageable risk for the meantime. I say for the meantime because if we go vertical, these would actually have been the last opportunities. We don't know that, we're not psychic. I'm just saying what the data is telling me at the moment suggests a return to strength rather than a loss of it. We were witnessing a slowdown. That slowdown seems to have abated. Now, in the weekly time frame, we saw in the bearish divergences which built up from March 24, we saw 1, 2, 3, 4 bearish divergences of lower highs across higher highs before we had this breakdown into April 25, all the way back to weekly oversold conditions. Bullish divergence on the smaller time frame playing out here on the daily. We'd have to come in and see that. This is on the weekly, and then we rallied to overbought conditions again. We are overbought on the weekly time frame now, and as you can see, there is no weekly divergence. Unlike here, where there was several months of warning we were about to break down, there's nothing yet. Now, obviously, this is divergence. If it was present, it would only be between current price and previous highs with no pivot confirmed in place. There is no pivot confirmed in place, so it wouldn't matter anyway. Here we can see on the MACD we've been slowing down, right? The curve is becoming less vertical, but we continue to make higher highs on the average and signal lines. The momentum overall in the histogram is waning, but it's way more powerful than what we saw in previous rallies over the last couple of years, ever since COVID, really. So yeah, essentially no sign of it slowing down yet. OBV continues to puncture for higher highs as well with no divergence. So no bearish divergence at all on the weekly time frame. Bearish divergence that was present of the daily time frame is now disappearing. No reason to think the rally's over yet. But let me be absolutely clear, that can change in a day. Right, so it's all well and good saying, oh right, Tom says it's going to go on forever. I'm not saying that. I'm saying for the moment there's no sign of it having abated or stopped. There's actually signs of it having increased in strength and directionality to the upside, but that can change in an instant. But we'll know if it does. Right, we'll see the pivot, we'll see the breakdown of the trend, we'll see warning signs of smaller time frames translating to larger time frames, but none of that is present yet. So there you go. Now on the monthly time frame, I don't tend to come out this far, but I do remember pointing out, you can probably go back and find the video, when we did bottom in April, this insanely bullish candle. Right, I think I'm on record, and I don't mind if I'm proven wrong as somebody goes back for the record, but I am on record for saying that this was the most bullish candle I've ever seen. Right, and it was. So to have been betting against a rally here after witnessing that would have been a pretty foolish move, and that's exactly what it would have turned out to be, because we've just gone from strength to strength since that point. Okay, now we're still above all the major moving averages here. As you can see on the monthly time frame, a really big correction can bring us down to the 60 exponential moving average, like the multi-month, almost, was it January, topped in December 21, bottomed in October 22. So we went on for a fair old while we brought this down to the 60 monthly moving average. The last big correction we had was that April. We haven't gotten close to anything since. Indicators suggest some weakness between multi-month highs over several years in the RSI. We currently have weakness between the prior high of November 24 and the current highs, but there's no pivot in place on the smaller time frame yet. So we can't say this is bearish divergence. It's divergence between previous highs and current price, not a confirmed high. But if we were to get a pivot into place and it were to play out across smaller time frames, then we could look at the monthly chart here and say, right, monthly pivot in place, that could be a pretty significant sell-off. MACD, however, between that high back in December 21 and all the way up to here in January 25, there's no divergence, but there is divergence between the January 25 high and the current high, but once again, it's non-confirmed, there's no pivot in place, this can move higher, but it would be evidence for a longer term pullback if it were to confirm on smaller time frame. No such luck here on the OBV. We continue to accumulate more and more bullish volume over time. That's just flat out bullish. So there you go, that's your classical analysis. Now I'm going to do something else a little bit different here. I'm going to zoom out for a minute and I'm going to go and look at the PCC and the VIX first, and then we'll finish the Elliott Wave count. You might say, why are you doing this? Well, I'm going to announce at the start of the Elliott Wave count as well that I honestly believe that in this video, at this moment, with the evidence we have, you are better off looking at classical analysis than you are Elliott Wave analysis. Elliott Wave analysis is built on wave degrees, and wave degrees are built inside of one another. The larger the wave degree, the more confirmation we have of where we are in a broader count. If it doesn't give you anything for weeks or months on end, you really are just pissing into the wind, because you're getting down to such small time frames that all of your analysis can be broken in a few minutes. Now that doesn't, but the great thing about that happening is you finally get to make some longer term analysis, say, right, that was a 1 into a 2, that was a 3 into a 4, at this degree I now know where I am. It's very difficult to do that at the moment, so I feel we're probably getting more from our classical analysis. So on that note, let's have a look at the VIX. The VIX is still suppressed. It's down at 15 at the moment. It's come back to this kind of horizontal support line here. It may bounce, it may not. Whether or not support resistance means anything in VIX, all I'm measuring here in the historical peaks and troughs, and the peaks tend to speak a lot more than the troughs. What do I mean about that? By that, well, I've marked them in here, right? So if we go above the 50 on the VIX, I call that the panic line. If you go above the panic line, you are witnessing a significant volatility event which will appear on the SPY chart. A lot of these other spikes won't. They're temporary, they're small. But if you come over that 50 line, you're doing something pretty big and it's going to mean something. So we've got these green lines here marked on the VIX. Now if we come over to our SPY chart, we can bring up the same lines on our chart. And what you'll notice, unsurprisingly, is they are synonymous with finding lows in the market. High volume, high volatility, high momentum, significant low. Spikes in the VIX at any significant degree or scale tend to point to market lows, and this goes back time memorial, right? So all the way back to COVID, we can see a huge green spike here. We can look at the green spike back here in 2018 as well. We can look at the back at the ones with 2015, and more recently the April lows of 2025. Prior to that, we can look at the lows of August 24, and we can also look at the lows prior to them as well. So we've classified the most recent ones, for example, as tariff trade war panic at 60.13. This had a lot of people shitting their pants and just freaking out really over an absolute non-entity, as it has turned out to be. I'm not saying it's not going to have a long-term impact, I'm just saying there was no need for the panic at the time. Okay, it was actually a low in the market, an excellent buying opportunity, and that's when it tends to be the case. When everybody shits the bed, you should probably be buying. Then we had the 2024 recession fear. This was a 65.73 reading. Once again, this is a low in the market. Then the next really big ones were COVID at 85.47. Like I said, there's been lots of other little lows in the market since, but none of these major events. And that was 85.47. And then finally the GFC at the all-time record of 96.40. These are like god level panic events. Okay, so these are all marked on the VIX and these are all marked on the chart. Now we've got the PCC. So the PCC is a load of noise that we've smoothed out using some major moving averages, and we can introduce any scale moving average we want. We can have the daily if we want, which would look like this, okay, or we can smooth it out maybe to be a 5-day, a 10-day, a 20-day. I'm more concerned with long-term trends and their impact on the market. So what we're looking at here is it's smoothed out to the 20 and 60 so the 60 and the 250 exponential moving averages, which is the orange is the 60, the 250 is the green. And what I notice during these cyclical bull and bear markets, we see a long-term move into extreme fear and bearishness, and then we see a long-term move back to extreme complacency and bullishness. Now, if we take the extreme fear and bearishness conditions, which are the yellow lines we see here, for example, we've got 3 of them here during December 22, September 22 and June 22. We came into peaks here before we had a correction back down towards complacency before we came back up into fear again. If we look at that area here, we can see it corresponds to these series of 3 lows here in the market. Okay, so we can get a pretty good grasp between the PCC and the VIX that if we're up in extreme fear or bearishness while witnessing some kind of heightened VIX activity, or even better yet, a spike in VIX activity, like we saw with the October 23 here on the PCC. I'm not sure if that's actually on there. October 23, it's here. So let's just put that little line in as well. I can't remember what the exact date was. It was the 31st. Oh, it's one or the other. 26th or 31st. Obviously there's a week there, weekend there. So if we move it straight, it's basically the low, right? So as you can see, that was a PCC high here, but it wasn't a high in the VIX. Was it? October? No, it wasn't. It was one of these highs back here, but it wasn't a significant volatility event, but it was a significant event here on the PCC on the put the call. So between these lows, right, these extreme fear and bearishness readings and the VIX, we find lows consistently on the SPY. So first things first, before you obsess over short-term Elliott wave counts, and if you're dumb enough to actually follow the news cycle and let that make the worst possible decisions you ever could, which is doing exactly the fearful things they want you to do in those moments, you would never make any money. But if you actually did the opposite, right, and that's what we're talking about here, which is get bullish when others are fearful. I know that's what the old man says, and he was absolutely right to say it, right? If you just practice that on the longer term, you'd be quids in right now. Because as long as you're not leveraging yourself up to the eyeballs and taking stupid bets, if you're just buying yourself back into the SPY every time everyone shits the bed, you're smashing it. You are absolutely smashing it over time. And this probably applies, well, not double, percentage points more in the Qs, or the NASDAQ as we call it, right? Because NASDAQ grows even faster than the SPY, has greater returns, roughly between 12 and 14% a year, as opposed to between 8 and 10 here in the SPY. So if you were to average down every time this happens to the NASDAQ, right, you're killing it. There was a video I've got on my channel which is about long-term view of investing and how we should look at these charts, identify these factors, identify these trends, and approach them logically. And yet, coming back to my initial point, this is still one of the most hated rallies I've ever witnessed, which tells me that a lot of people fell for the fear down here and did not take the opportunity, so they're not learning this lesson. And so I will reiterate it, and I'm not doing it to upset you or insult you. I'm literally trying to help if you're new, because we're all human and we all react emotionally and we all do stupid shit, right? But we should just remember that when the volatility spikes and the news cycle supports the volatility and the put the call ratio supports the volatility, we should be buying, not selling. So there you go. There's a lecture for that, to wrap up the classical analysis side. To actually look at the PCC, we're on our way back to extreme complacency and bullishness, but on the longer term time frames, like the really significant lows we've seen before, like back in January 2010, back here in January 2014, this sustained period of lows during COVID, right, we're not there yet. Now we could spike before we get there, but we could also push into more extreme complacency and more extreme bullishness. For all the bullishness of this rally, it's not that unusual historically. It can get more crazy. VIX wise, there is no volatility. The last spike we had was a tariff trade war panic. Right, if we spike above this downward trend line and start getting above these recent highs, we can talk about volatility. If we get back above the panic line, we should be remembering what that means from a long-term investment view, rather than actually joining in with the panic. So one other thing I forgot to mention, we've been looking at PCC and the VIX, is how this interacts with oversold conditions in the RSI. So if we log the bottoms here with the oversold conditions in the RSI, Now we've looked on our SPX chart. If you go back and look at the video about long-term investing in the stock market, the interaction with the ISM and the interaction with the University of Michigan Survey's Consumer Index, right? We're not talking about those here. We're just talking about the RSI, PCC and the VIX. If we bring up that data, let me just show you the first, PCC and the VIX data, right? And now let's bring up the oversold conditions in the RSI. Between these three indicators, we can call the bottom of the market easy peasy. Right, calling the lows is a piece of piss. And guess how you get rich in this market over the long term? It's by calling the lows. Right? And there are a lot of people out there on the internets and on central old school media like, oh, don't try and time the market, don't try and time the lows, you can't do it. I'm not saying you have to. DCA over time in this market is its own reward. Same with the Qs, same with Bitcoin, right? But it's my point is, it's way easier to spot the lows than it is the highs. Way easier to spot the lows than it is the highs. And having put all of these wonderful excuses in place about why my Elliott Wave count's really tricky and difficult to understand at the moment, we can now move on to the Elliott Wave segment. Alright, I've spoken about the long-term view, I've spoken about how difficult it is to find a higher wave degree when the market won't pull back, and therefore we are left with some pretty radical ideas and pretty extreme ideas, and also some pretty blasé ones. So let's start with the extended fifth wave. Right, and let's come into the 4 hour. So coming off of the April low, we saw two corrections of something resembling mildly significant, 3.4 and 7%. Since then, we've had nothing the likes of 1.96. What was this one? 2.93%. Similar to that other one. This was 2%. This was 1.6. You get the idea, right? So what if we went 1, 2, 3, 4. All of this is an extended fifth. And the fifth of the fifth is extended as well. So what do I mean? Well, it's either not extended and it's this little diagonal I've got, 1, 2, 3, 4, 5. We can calculate when that should end any moment. Or inside of the fifth, it's going 1, 2, 1, 2, 1, 2, 1, 2. And that divergence is breaking down. We're getting an extended third within an extended fifth of a fifth. Or maybe it wants to be an extended fifth of the fifth of the fifth. Fuck knows. Alright? Nobody knows. But either way, we could be in that fifth and final move up. Forgive the bad language. I'm not like, trying to come off as irritated or something like that. I'm as kind of antsy about it as everybody else at the moment. I would like to see a correction. Of course I would. I'm long, as my group knows, as many of us are, but we would all like to have been a bit longer. Okay? Because, some kind of sensible pullback would have been nice. But this thing could be a rocket ship. So let's just measure potential fifth wave finish if it's a diag. We can put a cutoff in place here. We can say, well, in the ending contracting diagonal, we can't have the length of the fifth wave go beyond the length of the third. The third, traditionally, in previous Elliott wave theory, could not go beyond the length of the one, but it can now in the updated theory. So if we were to come up to our proposed one here and measure, we can see that the 3 actually came within the length of the 1 and the 5. So it's a more traditional diag in that regard. It's a more traditional ending diagonal. But either way, it gives us a target of 186. What was it? 186 spot 16. So we will call that. I've got problems with the chart loading at the moment. It keeps lagging. Bear with me. Let's try that again. Nope, it's not liking it. I'll save it. No, I've got a connectivity issue at the moment. I'm not really going to risk reloading the chart if it's not saving, so we're just going to hang in there. Either way, this red line, 681 spot 16. Hopefully this will correct itself shortly. That seems to have worked. There we go, we got it back. Invalidation. And we could put a little price target up here. Right, go beyond this, and it wasn't an ending diag of any sort. Right, it'll start to look well weird before we get there anyway, and by the time we get up here, we'll be pretty convinced that we're in a massive extension by then anyway, so kind of meaningless, right? So we're going 1 2 1 2 1 2, and we're about to take off, or we're going to finish imminently. At worst case scenario, sometime before 681 spot 16. Like I said, no larger wave degrees, no clues. There's no evidence, and especially with the classical analysis pointing in the direction it is now, basically impossible to call an end to this anytime soon. Right, we'll only know it when we see it. Right, so now let's look at some alternative ideas. What if it's a melt up? Right, this is out of all the unliked and improbable and counts which are least favourable to people, ones they're least willing to entertain, especially if you listen to some of the media out there at the moment, is the idea that we're actually going to go on a rocket ship to the moon. And the unemployment issues, the potential fear of inflation coming back, it's all complete bullshit, and the market's going to go absolutely to the moon, or it's going to do it regardless of any bad data anyway. And bad data is going to be interpreted as good. Okay, this is the scenario which explains that. This is 1 2 for days. So it's 1 2 at intermediate degree, up this larger correction. This slightly smaller correction was 1 2 at minor. This smaller still was 1 2 at minute. This smaller still was 1 2 at minuet. This smaller still was sub minuet. This was micro. This was sub micro. We're into sub micro 4 5, looking for 3 at micro 3 4 5 3 4 5 3 4 5 3 4 5 3 4 5. Right, and it's going to go vertical, and then it's going to spend a lot of time overlapping and topping out. At least this invalidates sooner. So we can break down this count if it falls back below 643 spot 33 at the smallest time frame. 643 spot what did I say, 643 spot 49 was that? 33, what am I on about? Fall back through here, that breaks this wave degree, come all the way back through 619 spot 30, we've broken the larger wave degree upward trend, and we've finally got a correction on our hands, something significant, something of more than 6%. Oh my god, can you imagine having something as big and mighty as a 6% correction? But at least it would clearly break this upward trend. Right, and until we get something bigger like that, we can't put a larger wave degree on what's going on here and say finally a 1 into a 2, finally a 3 into a 4. Right, it's all just smaller and smaller wave degrees building up momentum the whole time. Right, so maybe it's this. But at least you can trade off of these lows, right? So if you're not in, at least you've got some entry points. They're not a million miles from you. Where are we today? If we open it, if the pre-market's correct, you know, we are 2.84% away. Unleveraged, significant allocation. That's a manageable amount of risk for anyone's portfolio. But if it starts to go vertical, those stops are going to get further and further away. Right. So that's the extent. That's the melt up. Bearish idea. Everything from the low of April 25 was a correction, a corrective B wave. That was just a giant head fuck. And this doesn't cut off until we go through 694 spot 95, which is a 1618 extension of the A wave down, which was the highs of February 25 down to the lows of April 25. This is 3 waves down. This is complex double zigzag back up into a B. Now, I'm not saying it's impossible, but every day that it continues, it becomes less likely. Not only because we're going beyond the more typical target zone of 123.6 to 138.2, but because the time frame is getting pretty extreme. Now, B waves can drag, there's no doubt about that, but this is getting pretty silly at this point. We are now, there's 1 times the length, 2.61 times the length. We're miles longer in time frame now than our A wave was. So what could I bring out? 3 times is there. So we need a more significant. So what about 8 times the length? No, that's all the way there. I'm spitballing it. 4 times the length. Getting on for 4.5 times the length. If not, yeah, there we go. currently the B wave is 4.5 times the length of the A wave. Seems a bit ridiculous. Right, seems a bit ridiculous that you should take so long. Not saying it's impossible, but who cares, right? If the top's in, the top's going to be in. We're going to see this trend of higher highs and higher lows break. You can be as bearish as you like there, because whether it's 1 that we come into, we've got a huge correction down for a 2, or whether it's a B wave and we're coming back below the lows of April 25, it doesn't matter. We need a bearish pivot in place before we start getting bearish, you know. And there's nothing there's nothing I dislike more than people go, oh, it's going to crash, it's going to crash. So, has it? No. Let's deal with it when there's evidence, when there's a sign of a pivot in place. Then we can get bearish. If you're not careful, like many people have, you'll talk yourself out of ever participating. And there's no bigger cost you can pay than talking yourself out of participating in these markets long term. So, right. So to sum up our Elliott wave counts, we've got the possibility that we're in an extended fifth wave up. This could take the form of an ending diagonal, which is invalidated at 681.16. Otherwise, it's 1, 2, which is this orange count, 1, 2, orange count again, and we're extending 1, 2, 1, 2, 1, 2, 3, 4, and we're just going up an extended fifth. Right, and there's no limit as to where that can be. Right, because the fifth wave can be it already is the longest. Right. The 3 wasn't the shortest. That's the only other rule that matters in Elliott wave. So the fifth is pretty much unlimited in this count. If we come to the melt up idea, then it's not. We haven't done the fourth wave at minor degree yet. We've got 1, 2 at intermediate, 1, 2 at minor, 1, 2 at minute, 1, 2 at minuet, 1, 2 at sub-minuet, 1, 2 at micro, 1, 2 at sub-micro, so on and so forth. And now it's 3, 4 forever. We're going to have a vertical move and a whole bunch of overlapping, going higher and higher, bigger and bigger, more and more overlapping until the market finally tops out. Okay, then you got the bearish idea. Market's imminently going to peak, and it's in the major target zone between the 123.6 and the 138.2 extension of B wave. But if it goes beyond 694.95, this is wrong. We pointed out the problems with the time frame of this count. So to reiterate what I said earlier in the video, I know a lot of you have been long-term followers, so you probably haven't got this problem, right? If you're new to the channel, then maybe the first thought you should have before obsessing over whether or not you understand all this Elliott wave stuff is a long-term appreciation of why it matters to take a longer-term view, an understanding of when the market lows occur and why we should be bullish at them rather than bearish. Now you might think, oh, well, it's great now, but the market's going to the moon. It's always going to the moon. Alright, it's always going to the moon. It's all it's ever done. Right, so don't fret. You will get your opportunity. And if you were to even start DCAing into it now for the next 20 years, you would likely be, most likely, if historical averages hold, which they have done ever since this thing began, you will be rewarded for your patience. But don't worry, a larger pullback will occur again. We will get to find the lows again, and we'll get a pretty good guess of where they are when they occur. All right. So, like I said, you're probably going to get more from the classical analysis of this video than you will the Elliott wave. When something bigger happens, we'll get a clearer idea of where we are on the Elliott wave count, or if we go vertical, we'll know where we are in which Elliott wave count. Alright then guys, thank you very much for joining us. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon in the video to remain informed of future video releases. And if you're interested in learning some of this technical analysis stuff for yourself, Elliott wave, and joining a Discord and a community where there's lots of ideas and people contributing constantly, and loads of educational materials to learn about trading as well, then feel free to sign up to my Patreon and it'll give you access to all of that. And if you don't like it and you're not happy with it, you can always leave after the first month, and it costs you no more than 10 quid to find out. So up to you guys. But either way, whatever you choose to do, take care of yourselves out there, manage risk, and I'll be back with you as soon as I can. All the best. Bye bye.